So go down in that page. And if you go down to row 32, cell G, row 32, cell G and H, right? It has the S&P 500 return, right? Are those hard-coded or are those an equation? They're hard-coded. They actually should be an equation. So let's go through the math right now so that you guys can put it in. Because what I don't want you to do is to do this, and then at some point in time you want to go back and use this worksheet again, update the data, and then update the index calculations so you can calculate the alphas. Because you may want to use this as a project or something at some point. So here's what we're doing. So you have the portfolio return, which is cell F33, cell F33 on 1 year backtest, right? And then you have the S&P 500 return, right? So your return on your portfolio minus the return on the index gives you the alpha. So it's the basis points in which you beat the benchmark. That's the goal, okay? That's the goal. You guys understand? I'm back testing my portfolio. I got 1, 3, 5, and 10-year returns on my portfolio. I'm going to compare my returns to the return on the S&P 500 for 1 year, 3 year, 5 year, and 10 years. I'm going to subtract the return on our portfolio, my portfolio, minus the benchmark return is going to give me the alpha. That's the basis points in which I beat the benchmark. If you can beat the benchmark consistently over time, people are going to invest in your fund. If you don't beat the benchmark consistently over time, they're not going to invest in your fund. Because why would I invest in your fund when I can invest in the S&P 500 ETF or mutual fund and get a higher return than your portfolio? Ain't gonna work. So that's extremely important. So here, you need to write this down. Okay? So this is the equation. Can you pull up the S&P 500 index for me and give me the data? Okay. So I'm gonna need the data. All right. So the first thing we're gonna calculate, I'm gonna calculate the returns. And then what you should do is build the equation in Excel. And if you need help, I will go audit it for you. Okay? All right. So we're going to do the 1 year return. So this is the way I would set it up. So the first thing we're going to do is we're going to do the S&P 500. And we're going to do it as of January 1st, 1119. And we're going to put it right there. So can you give me what the S&P 500 index was as of January 2019? Because what you're going to do, what you should do, this would be my recommendation. This is going to be your 1 year return, okay? And then what we're going to do is there's 3 forward test worksheets in there, 3 forward tests. And what we're going to do is at the end of next week, we're going to put the S&P 500 as of March 30, as of the most recent date, calculating the return as of March from January to get basically a first quarter estimate of the return and then benchmark it. Okay, but now we're doing the back tests. So I need the S&P 500 index as of January 2019. Can you give me that?
Like January 1st.
What is it? Yeah, January 1st, 2019.
2,510 and 3 cents.
2,510.
And 3 cents.
Okay, just leave it, we'll just round.
Alright.
And then give me the S&P 500, 118. So I can calculate the annual return.
$2,743.
2,743. Got it. So what is 2510 divided by 2743? You probably need your calculators, or you need an Excel spreadsheet. So what's 2510 divided by 2743?
0.9150.
What is it?
0.9150.
Got it. So when you see something like this, what does that tell you about the total return over the last year? Is it going to be positive or negative? Negative. Got it. So that's how you can check your numbers. And then, what's 1 divided by 1? This is 1 year. 1 divided by 1 is 1. So the number is, this to the exponential of 1 is the exponential. Got it. Minus 1 times 100. Got it. So what's 0.915 minus 1?
0.085.
What is it?
Right, 0.085.
0.081. Is that what you have? 85?
Yeah, sure.
Got it. Got it. This, we already calculated that. Times 100. What does that give us?
I mean, it's negative 0.085.
So I basically take the current index level divided by the prior index level. I get 0.915 minus 1. I get 0.085. 0.085 times 100 is negative 8.5%. So the S&P 500 as of January of 2019, from January 1st, 2018, is down 8.5%. Do you get that? Okay. Now let's change it. Let's go back, let's do the 3-year. So what is this? 19, 18, 17, 16, right? So we did the 1 year, now we do the 3-year. So give me the, watch this. So give me the index level as of January 1st, 2016.
$2,043.
$2,043.
$2,403.
403. Got it. 03. Now I'm going to change this to 3. And that's going to be what? So what does this turn out to be? Let's say 2510 divided by 2403 times to the 333 exponential. So what's this divided by this?
1.04.
What is it?
1.044.
1.04. What's 1.04 to the 0.333 exponential?
1.0144.
What is it?
1.0144.
Got it. Minus 1. What does it give us? 0.0144 times 100.
1.44.
It's going to give you 1.44%. This is your average annual growth rate over 3 years. Is that right? Is that calculated correctly? Did you check and audit, make sure it was correct? So this divided by this gives you this. This to the 0.333 gives you this. minus 1 gives you that, times 100 gives you the percentage. Here's the key to this calculation. Are you following me? Okay. Here's the key to the calculation. Once you get here, you know what it is, right? I don't need to subtract out 1, and I don't need to multiply by 100, because I know that it's 1.44%. So I can skip these two. It's more accurate to do it this way. You're going to have to, I think when in the programming in the Excel, you'll have to do this. Okay, you'll have to play with it. Does everybody understand how to do average annual compound? This is compound. These are average annual compound growth rates. So, Megan, here. So you're asked by a senior managing director, will you calculate the average rate of return on the S&P 500 for me? What you're going to do, most students will just take the percentage change and divide it by 3. Right? Is that the easiest thing to do? Calculate the 3-year average on the S&P 500. Just take the percentage change between today and 3 years ago and divide it by 3. You know what I'm saying? Most students would do it like this. 2510 minus 2403 divided by 2403 divided by 3. That's how they would do it. That's wrong. You got to use average annual compound growth rates, because there might be outliers, controls for the outliers. You're using the base. Current, prior, whatever the years are. Get the ratio to get to the 0.3, get it, minus 1, get it, times 100, boom, you got the percentage. But I don't need to go any further in most cases, because I know what it is right here. I don't need to go through this. Does that make sense? Does that help? Do you understand? Okay, so let's do the 5-year. So what was the S&P 500 in 2014? What is it?
1,872.
1,872, got it. And what's the ratio? What's 2510 divided by 1872? What's the ratio?
1.34.
What is it?
1.34.
Got it. And then what do I take it to?
5.
1 divided by 5 is what?
20%.
0.2?
0.2.
Is it 0.2?
Correct.
Got it. So what's 1.34 to the 0.2 power?
1.06.
What is it?
1.06.
0.06. What was the average annual compound growth rate for the S&P 500 over the last 5 years? What?
6%.
6%. Right? Because if I subtract out 1 minus that, I get what? I get 0.06, and if I multiply by 100, I get 6%. So you don't need these last 2 procedures to get the number. It's correct in your programming, but if you want to get to the number really quick, you know that this is 6%. Times 100. You got it. Let's do the 10-year. What was the S&P 500 10 years ago?
797.
797, got it. So what is, oh, that's going to be a big number. What's 2510 divided by 797?
315.
What is it?
3.15.
3.15? Is that correct? Is that right?
Yeah, you're right.
Okay. And then what is that 3.15 to the 0.1, right? This is 1 divided by 10 is 0.1.
1.12.
1.12. Right, so what is it?
12%.
Being able to do average annual compound growth rates is so important. It's the first thing I learned when I became an analyst. Okay? Because that's the way we calculate our returns. So if you can put those into your back test, you'll be able to then calculate the alpha, and you'll be able to see how much you beat the benchmark index in basis points. Okay? And I'll come around and audit it too to make sure it's correct. All right. Any questions or anything? All right. Did you guys take a picture of that, or you want to take a picture of that, or just to get an idea what the formula structure is? Yes.
Can you just show me how to do it on the Excel sheet?
Yeah, I'll have to go around and show you. Actually, yeah, I'll have to come around and show you.
Right now.
Just hard code it for now.
For now?
Yeah, just put in the hard codes for now, and then I'll come around and I'll show you how to do the calculations. Just make sure you write down the index levels. Okay, make sure you have the index levels.
Okay.
All right. You guys ready? The next thing? Okay. Can I erase this?
Yeah.
All right.
What is it?
Yeah, I've already got it into the Excel sheet. I just
Oh, wow.
So, since I'm already over here, I might as well just start over here. Let's do is everybody clear on the derivative trades for the derivative trades? This is on your pretest, right? And this is what you're using for your memos, right? You think that the prices are going up, you basically can trade indexes, ETFs, and stocks. If I think the prices are gonna go up, or the index levels are gonna go up, you guys all ready so you can write this stuff down in your pretest? If you haven't written it already, we're going over it right now. So if you think that the prices are gonna go up, or the index, if you think the index levels are going up, these are your derivative trades. These are your trades. You're gonna buy forwards, you're gonna buy futures, you're gonna buy calls on futures, and you're gonna write puts on futures. Okay? If you think that the exchange traded fund share prices are gonna go up, you're gonna buy on margin, you're gonna buy calls, and you're gonna write puts. If you think the stock prices are gonna go up, same trades. You're gonna buy on margin, you're gonna buy calls, and you're gonna write puts. That's it. Is everybody clear? If you think that the prices or the index levels are gonna go down, you're gonna write forwards, write futures, write calls on futures, and buy puts on futures. If you think that the ETF share prices and the stock prices are gonna go down, you're gonna sell short, write calls, and buy puts. Okay? And maybe next week I'll do a quick brief introduction to the different derivative trades. But these are the mechanical trades. Okay? There's only two sets of trades. When prices go up, indexes go up. When prices go down, indexes go down. That's it. All right? Buying on margin, I got $100,000. I want to buy Apple stock because I think the price is going to go up. I want to buy on margin. So basically, I borrow $100,000 from the brokerage firm at 9%. I can now buy $200,000 worth of Apple stock instead of $100,000. I just leverage my position. When you sell short, I own Apple stock. Apple is trading at $200. I think Apple's going to go down to $100 a share. So what I'll do is I'll sell short. I will lend you my shares. I'll sell them. You're borrowing my shares. You're giving me $200 per share, okay? And I'm lending you the shares because I'm going to buy them back later on, okay? Let's say that the Keith thinks the share prices are going up, I think they're going down. I lent them to you, I got $200 a share. The price of the share goes to $150. He's out. He goes, I'm out, you know, I can't handle it. I'm out. I'm gonna buy them back from you at $150. So I sold it at 200 and I bought it back at 150. That's selling short. Okay? And then I'll go through these derivatives, and the book goes through the derivatives too. Plus it's on the pre-test, plus it's in the take-home exams too. Okay? But I'll go over kind of a quick and dirty introduction to the derivative trades. Okay? In regards to the technical securities analysis, and I'll probably bring in a little bit more technical securities analysis later on. But this is the basic techniques that you will need to conduct technical securities analysis. There's different, what you're learning in the book, there's like one little discussion on technical analysis in the behavioral finance chapter. So they don't even really talk about it. But almost all traders of equities, fixed income, currencies, derivatives, use technical securities analysis in conjunction to the fundamental analysis that you're using. So you need to understand some technical analysis. We already did go back, didn't we? Go back already, and didn't I show you the moving average crossovers? Didn't I take you up to stockcharts.com and show you how to do the 10, 30, and 50-day moving averages? Did everybody see that? Everybody understand that? We're going to talk technical securities analysis. Because what you're going to be doing in this class is you're going to be doing technical securities analysis using the moving average crossover system to trade the securities. All right? So if you go to stockcharts.com and you type in AAPL, this is what you need to do for your memos, okay? And then for your reports, because you're going to be printing these out for all 25 of your stocks, okay? So here you go, Apple, you got to go down here where it says fill the chart. How am I doing on time?
25 minutes.
Okay, perfect. You go to 3 years, okay, go to 3 years, and then hit update. Now I got the 3-year chart. And then you're going to go down here to where it says overlays. And the first one you're going to do is 10. So you're going to do a 10-day moving average. You're going to do a 30-day moving average right here. Like that. And you're going to do a 50-day. You're going to go here, click on simple moving average, hit 50, hit update right there. And make sure you have the RSI and the MACD. You want that too, because those are technical indicators for trading purposes. Bam, here's the chart for Apple. I can technically trade this chart. I can technically trade this chart. And this is how I would trade it. It was so funny, the other day I was sitting in a finance department meeting, and they were all poo-pooing me on my technical securities analysis. Okay, they believe it's voodoo finance. Well, tell that to some of the most successful traders in the world who use technical securities analysis. So let's do the analysis. Let's apply that over there to this. So right here off the bat, I can see that there's a support that formed right here. So this is your support line right here. This is the resistance line right here. So basically the stock looked like, here's the support, here's the resistance. It broke out right here, formed another support right here and another resistance before it broke out right there. And then it was on a stock run. Formed a support, resistance. Actually, this looks like it could be a trading range right here, broke out here. This looks like a solid support. This is the resistance, broke out here, support, resistance, break out to the upside. And then here, this prior resistance right here, it blew through that, and then look at this is another, looks like a support right there too. And it looks like it tested its historical supports in later 2017-18, dipped a little bit below it, so it really kind of formed a price support, and then has moved back up. So basically from the technical charts, you can see how it's trading, but is it in an overall upward trend? Yeah, it's in an overall upward trend. So if it's been in an overall upward trend for 3 years, where do you think Apple stock's gonna go? Probably continue to go up, okay? Unless something major happens to the company. Here are the, this is the RSI right here, and this is the MACD right here. And as you can see, that they're highly correlated to each other. Right? These are momentum indexes. And you can see it peaked out here, here. So what it is, it's a log normal chart that basically allows it to kind of move up and down. Right? So it's a log. And then these are momentum indicators. So you can see that when it was moving down, and it bottomed out here, and it's moving up. Okay, so these are two momentum indicators. This is the technical chart, and then I use the 10, 30, and 50-day moving average. Okay, and what will happen is the 10-day will cross the 50-day first, and then the 30-day will confirm the movement in the stock. So that's all we have to do is we're alerted when the 10-day moves across the 50, either up or down. But once the 30-day, along with the 10-day, either move up above the 50 or move down below the 50, if the 10 and the 30 move up above the 50, you buy the stock. When the 10 and the 30 move below the 50, you sell the stock. That's it. It's just it's a momentum trading system. It's mechanistic, it's rules-based, it's totally unemotional, and you can make money doing this stuff.
Wait, why the 50 again?
The 50-day is basically a long-term trend line, and the 10-day is really sensitive, right? And the 30-day is somewhere in between the 50 and the 10. I found from my research that the 10, 30, and 50-day moving average crossover system produced the best trading results, the most profit. I could use 5, 15, 25 if I wanted to do almost day trading stuff, but it doesn't work as well. I could have used a 100-day, 60-day, and 20-day moving average if I wanted to. You have to back test it, but just based on my experience, the 10, 30, 50 generated enough trades to make the trading profitable. Okay, so this is what you want to use for all 25 of your stocks. You're going to conduct the technical analysis by your technical analyst, and then you're going to basically identify all of the buy-sell trades and the prices in which you bought and sold them, and you're going to stick them into your profit-loss worksheet, and you're going to calculate how much money you would have made over the last 3 years if you implemented this trading system. Okay, and we'll do that during like the midterm period. We'll start getting into more heavy-duty, quant stuff. Yes.
So I have a question. So when you're looking at this one that you have us,
Yeah.
like at the very beginning when the 10
Yeah.
and the 30 are both above the 50.
Yeah, when the 10 and the 30 are above the 50, you hold it. It's a hold.
It's a hold or
Yeah,
a
so you
buy?
bought it. So when the 10 crossed the 50, that was your alert, your buy alert, and then
Uh-huh.
the 30 crossed, that was your buy signal, and then since the 30 and the 10 are still above the 50, you're holding the stock.
Okay, so it's that you buy when they cross in an upward motion?
Yeah,
Because,
so
like,
when the
they're
10
going down.
crosses, then the 30 when the 10 crosses,
Mhm.
that's your alert.
To buy.
When the 30 crosses along with the 10, that's your buy. That's when you buy. And it's the same on the downside when you sell. So you can see right here that the 10 and the 30 were well above the 50, and it
That's
just,
why.
and that's what you, and then you sold here and you pocketed the money, right? And then over here, you were kind of trading in here, and then the 10 and the 30 went here. That was probably a small, false signal, but even if you did sell here, you made that money.
Okay.
Then you bought it here, you rode it all the way up, sold it to there, right? And since the 10 and the 30, you were just like, I'm just gonna hold my money, and then boom, the 10 and the 30 crossed, I'm buying it right there.
So it's not smart to buy after 50, or?
No, you're just buying on the technicals.
Okay.
You're just buying the technicals. So when the 10 crosses the 50, that's your alert, and when the 30 crosses the 50, along with the 10, that's your signal to either buy or sell.
The 30 crosses the 50.
Yeah, the 10 crosses first, then the 30. That's when you buy and sell. So, for example, let me do it again, because how much time do I have? What? How much? Okay, perfect. So let's do it again. Everybody gets this confused, so it's really critical to understand. 10, 30, 50. Okay. 50 day is basically a slow moving average, okay? Slow moving average. The 10 is very sensitive, and the 30 is somewhere in between. Okay. Let's just take this point right here, January of 2000, April, May, June, July 2017. 50 day is the green, it's right there. The 10 day crossed the 50 day right here in July of 2017. That was my buy alert. But I was waiting for the 30 day confirmation. I was waiting for the 30 day to cross the 50. Once the 30 day crosses the 50 along with the 10, it's a buy. Okay, then I buy it. I bought it here. And then I rode it all the way up from, what was it, $100 to, looks like 115 right here. And then the 10 day crossed the 50 right there, that was my sell alert. And then the 30 day crossed right there, that was my sell signal. So I got out, pocketed all that. And then all of a sudden, the 10 day crosses the 50 right there, the 30 day crosses, that's where I buy. And then I held it all the way up from, it looks like I bought it at 110 and I sold it at 142. Does that make sense? Okay. And then here there was a lot of trading going on, but here's where I made a ton of money, right? Because I rode it all the way up here, did all the trades, I was just inching my way up profitably. Then right here, at 220 bucks a share, the 10 day crosses the 50, and then the 30 day crosses, I sold at 220 and I didn't buy it back until 161. Does that make sense?
They're just so tight together.
Huh?
They're very tight together.
Yeah, but this is technical analysis. You have to, dig in and look at this stuff. And, I could build a system around this. I could build probably a computer, procedure around it to calculate it. But this is technical analysis. You're getting in, you're looking at the patterns, you're studying it, you're looking at the trading systems, you're really learning the systems. This is one of my favorite systems of all the technical analysis that I learned. Yes?
So, would a riskier trader, when they see the 10 cross the 50 instead of waiting for the 30, would they, like,
They're
say-
taking on more risk.
Yeah, they're taking on more risk if they put in.
Yeah, because they're going early. What I would do is I wouldn't do that. I would just shorten these time periods, 25, 15, and 5.
Right.
If I was going to become more of an aggressive trader, I would just change the moving averages.
Okay.
What I can do too on these moving averages, which we've never done in this class, is to do, when I get a buy signal, I buy on margin. When I get a sell signal, I sell short. We've never done that. And calculate the profits. The profits would be huge. And the thing that we haven't done in this class either is if I get a buy signal, I'm buying calls and writing puts. And if I get a sell signal, I'm buying puts and writing calls. So there's two more levels that we could go in this analysis to even generate more trading profits if we wanted to back test the system. And I think it's a pretty good system. I mean, on $1 million, all of my students over the last 2 years or 3 years that I've been teaching this class, on $1 million, they've generated about $100,000 a year in trading profits. So $300,000 on $1 million over a 3-year period. So that's pretty good. It's like an average of a 10% rate of return on just a very conservative strategy. So I think it's a pretty good. And this trading system is the best in a self-directed IRA because you don't pay any taxes on the capital gains. And trading costs are incremental. So it's perfect when you start making some money and you roll the money out of your 401k into your self-directed IRA and you start trading your own portfolio of stocks that you've selected. You got the guts, do it, or test it. Take some money and test it and see if it works. All right, let's go through the technical analysis and then we'll be done. I did that. I did write up the product innovation stuff if you want to take a picture of that. I have it over there, and then I have the bonds and the dollar dynamic supply demand analysis over there too, which you can use. And how much time do I have? 13 minutes. Okay, I'll try to get through as much as possible. So here are basically the technical trading methods, okay? So basically, technical trading analysis is just momentum trading. If stock prices been going up for quite some time, they're probably going to continue to go up. If they've been going down over a long period of time, they're probably going to go down, okay? It's just momentum trading. It's called serial correlation. Historical prices are correlated to future prices. Historical price behaviors. Stocks have recurring behavior in their prices. All stocks, all prices have the same type of behaviors. If you've been trading a stock for quite some time, you can recognize behaviors that will trigger trading opportunities if you've been trading it and analyzing it for a long time. So it's really pattern recognition. It's identifying the patterns within the price behaviors. You can also use time series analysis, regression if you want to do more traditional forecasting. Trading volume is huge too. As you can see, the trading volume over there with Apple stock, the trading volume peaks as there's more buy orders that pushes up the stock price. There's spikes in trading volumes when the prices go down because there's more selling orders. So the volume gives you an indication of price movements. Moving average crossover, we just went through that. Wedge patterns and flag patterns within pricing. Here's a flag pattern right here. Stock prices moves, gets really volatile, and then the volatility tapers off. The wedge pattern is you get a little volatility, and then the volatility increases significantly. Head and shoulders pattern. Here's a head and shoulders here. The stock price trades within a range, pops out, trades a little bit, breaks out to the upside, peaks, support, resistance, peak, head, peak, resistance, support. This is the shoulder, shoulders here, this is the head. This is Dow theory, okay? There's Dow theory, there's Wyckoff, there's moving average, there's oscillators, there's candlestick charting, there's all kinds of technical. And I on the website, I made copies of chapters that I thought were important from the technical securities analyst books that I have, and I posted them up there if you want to dig in and learn a little bit more about technical trading. The resources are available to you, okay? Wedge, flag, head and shoulders, Wyckoff method, the MACD, the RSI. There's also the investor sentiment indexes, put-call ratios, other sentiment indexes that will give you like put-call ratios. If there's more puts out there than calls, that's going to be downside sentiment, right? Because everybody's buying puts, thinking that the stock prices are going to go down, right? If the put-call ratios are low, then that means that there's more calls in place than puts in place, which means that that's more of a bullish signal. And the derivatives are going to be future predictors of current stock prices, okay? So those are just some technical trading. Let's do an example. So we got a stock, it's trading in a range. You can see the price is hitting its support, it's forming a support line. It won't break out to the upside, so it keeps hitting this price resistance, support. When the stock is trading sideways, it's called a sideways pattern. Sideways pattern, trading sideways. It's also called a trading range, when it trades within a range. It's also called range bound, because it's bounded within the range. It's also called an accumulation phase and a consolidation phase. It's accumulating information ready to pop, and it's consolidating all of the information within the marketplace. I believe that fundamental and securities analysis combined together is the best method of trading securities. Then you can see a little support formed here, a little resistance, then it broke out to the upside. Looks like it tried to form a resistance here, support here, here's the peak, there's the support again that was tested, here's the resistance again that was tested, and then it looks like it broke out to the downside, traded in a range, here's the resistance, here's the support, traded again, broke out to the downside, formulated a consolidation, an accumulation here, traded sideways for a while, and then broke out to the downside. Okay. This is like Yahoo stock trade, exactly like this. As you can see, the stock price was in an upward trend, then it was in a downward trend. The trading volume, again, when the stock prices go up a lot, there's a lot of volume, buying volume. When you go down really quickly, there's a lot of selling volume. Then you got your MACD and your RSIs. That's pretty much the introduction to trading. Okay. How much time do I have? 6, 7 minutes. I could probably do the supply-demand analysis really quickly, unless you want me to do the product innovation. Okay. Does everybody have the supply-demand analysis? Yes. Did I go over that last week? Did I do supply-demand analysis all the way up to what bonds, or no, gold? Okay, here's your supply-demand charts. You start off in equilibrium, supply curve, negative supply shock, positive supply shock, positive demand shock, negative demand shock. It's going to cause the supply curve to shift back for bonds, budget surpluses, and bond buybacks. Also, letting the bonds mature and roll off the balance sheet. What's going to cause the supply curve to shift out? Structural budget deficits, not enough demand to meet the supply of bonds due to budget deficits. And foreign and Fed selling off the bonds. Fed will sell off the bonds through open market operations, drive down bond prices, drive up interest rates. And then foreigners have been selling a lot. What's going to cause the demand curve for bonds to go up? Falling interest rates and Fed and foreign buying of the stocks, of the bonds. Disinflation and lower inflation expectations, low and falling stock and real estate prices. My stocks are going down, my real estate prices are going down, I'm selling off those assets and I'm buying bonds and going into a safe haven. What would cause the demand curve to go down? Higher expected stock and real estate returns. I think I give you a better return in the stock and the real estate market. I'm selling off my bonds. I'm not going into bonds. Rising inflation expectations and interest rates are going to cause the demand curve to go down, because why would I buy an asset that's losing value as interest rates go up? And then higher GDP growth rates. The economy is overheating, Inflation expectations are going up, interest rates are going up, and bond prices are going down. I'm not gonna buy a losing asset. Okay? And then the US dollar, what would cause it to shift back? Slow money supply growth rate, hoarding of dollars, and low interest rates and inflation. What would cause the supply curve to shift out? Higher money supply growth rates, and selling of dollars by foreigners. What would cause the demand curve for dollars to go up? Higher labor productivity and profit margins, higher expected returns on interest rates, higher expected returns on stocks and real estate, low inflation expectations would cause the dollar to move up, and what would cause demand for the dollar to go down? Low labor productivity, low expected returns, low interest rates, low returns on real estate and stocks. So those are the factors. How much time do I have?
2 minutes.
2 minutes, 3 minutes? Okay, just take a picture of this. Did I give you the notes on this last time? Did I give you the notes on this? No? Take pictures of this. Because these are basically the answer. This is the answer to the financial innovation and product development, which you already have watched the video online. So I think, isn't that everything on the pretest? On the pretest, are we done? Got it.